what does this paper look at? Right, this paper looks at the costs and benefits of financial advice. And where can I kind of set, what's kind of the setting for this paper, right? So think of active mutual funds. All of us know that active mutual funds don't outperform passive strategies. Yet there's still a lot of money flowing into active funds. So this is kind of a puzzle why that is the case. So this paper kind of talks about a distribution channel. So one of the reasons could be that active funds are distributed to households, to retail investors, through brokers, through advisors, and because of the distribution channel, people end up holding high-fee funds that do not outperform. Okay, so some papers that decided by Elton and Bergstresser, Chalmers, and Tufano. Okay, so this paper finds that mutual funds, Canadian investors who invest in Canadian mutual funds end up not outperforming. Okay, so they do not outperform based on the kind of a counterfactual of a passive benchmark. Okay, so I'm going to have 3 comments, and the main one is whether a passive benchmark is the right counterfactual. Okay, so is a passive benchmark really a right counterfactual for for this study, right? So, and the second is how bad is a 2.5% fee, and third, I'm going to conjecture some benefits, other benefits that are provided by financial advisors. Okay, so in Campbell's 2006 presidential address, he talks about 3 investment mistakes. First, the failure to participate. Okay, second, the failure to diversify, and third, the failure to refinance. Okay, so this paper is actually talking about a 4th failure, okay, the failure to reduce fees. All right, so what do we know about Canadian advisors? They don't help to reduce fees, okay, but perhaps they help to overcome some of the other investment mistakes, like the first, failure to participate, the second, to diversify, and the third, failure to refinance. They don't have anything to say about that, right? So let's look at advisor impact on performance. Okay, the advisor impact on participation, is reported in table 1 and 2. Okay, so in table 1, we see that advised clients are 35% more likely to, they allocate 35% more in risky assets than unadvised, right? So that's kind of a 35 percentage point change in the proportion of your portfolio you allocate to risky assets. Okay, so maybe you think that there's some kind of reverse causality. So they have an instrument to show that the effect is even larger when you kind of look at a regulation change, so that the effect is like 38.7%. Okay, so not only that, the number of funds that they invest in goes up to 3.4. Okay, so you can say that maybe they also helped to increase the diversification of the investor depending on what is the geographical location of these funds. Okay, so let's look at kind of what allocation to equities or to risky assets, what kind of impact that would have if you have invested over the period of the sample of consumer survey that they have from 1999 to 2012. Right? So if you look at the most traded ETF in Canada, okay, the TSX ETF, which started in October 99, you find that the performance of this ETF is 5.8% over this period of time. Okay? The index itself performed 6.2% per annum. All right? So the cost of tracking an index is not 0. You need to pay 40 basis points in tracking error, or part of this could be because of the expense ratio. Okay? The risk-free rate is about 2.7% if I use kind of the Canadian interbank rate as a proxy. All right? So if you invested in active funds through advisors, you are going to end up not outperforming the market, and not only that, you're going to pay 2.5% per year. All right? So that sets you back 2.5% per year. At the end of the day, you can estimate, well, that's about 3.7% net return. Right? So 3.7% I think is still much better than 2.7% risk-free rate. Okay, so how does this look like? It really depends on when you liquidate, right? So suppose you are looking at a risk-free rate, you're going to end up basically investing $100, you're going to end up with $145. But depending on when you liquidate, if you liquidate at the end of their sample period and you invest in active funds that do not beat the market, but you pay 2.5%, you will still end up more than the risk-free rate, right? So ex-post, you can outperform the risk-free rate. Okay, of course, what we really like the advisors to do is to allow us to allocate to the ETF. In that case, I would have much more. That's what we really like to do. But what the unadvised are really at, they are at the risk-free rate, and the advisors move them in between the top line and the bottom line, right? So think about 2 assumptions that we have to make. First is the equity premium more than 2.5%. Okay, of course, ex-post could be negative this year, but ex-ante it must be more than 2.5%. Okay, so, and second, do advisors help to increase kind of investors' participation rate? Okay, the paper tells us, yes, they do. It's causal. So if these two assumptions are true, then advisors add value, right? Because they help us to overcome the participation problem. Okay, we really, it's not really fair to benchmark them against a passive strategy because then they would not get compensated for their efforts to encourage participation. Okay, so as long as they extract only part of the rents from the equity premium, then they are adding some value, right? So maybe they are not crooks, but even though they are not angels either, right? So, so the second comment I have is with regards to the fees that they report, right? So one of the tagline numbers in the paper that you get away with is this 250 basis points that you pay in order to buy these mutual funds through advisors. Okay, so how large is this fee? Okay, so in a paper by Corano and others, they look at non-US expense ratios, and they find that these are really large, right? In the US, maybe about 1.5%, but outside of the US, they are really large. And in Canada, equity funds have an expense ratio of 2.56%. Okay, so these numbers, I think, seem to square up well with their numbers. So I think the question that comes to my mind is, are the funds chosen by advisors just worse than the average fund in Canada, right? So if the average fund, you close your eyes and you pick an average fund in Canada, you're going to end up with also 2.5%, then it's not really a question of bad advisors, but just bad Canadian mutual fund universe, right? So that's kind of my second comment. So the third, I'm going to try to conjecture. You know, of course, these are conjectures because we do not know what makes people hire these financial advisors, is that perhaps they help to overcome some ongoing equity participation costs. Okay, so, and also the interesting result which Alexandro presented was the insensitivity to bad market returns. So if they are insensitive to bad market returns, that means in times of financial crisis, maybe they don't liquidate. Okay, so one of the big problems that retail investors have is they see large negative market returns, they liquidate, and then they go to cash, right? At the time when the equity risk premium ex ante is the highest, right? Think of all the friends who sold all their stocks in March 2009, kind of missed the kind of 100% rise in returns. So I wonder whether advisors help to prevent mistimed market exits. Okay, so suppose during the credit crisis, this is kind of one setting that they can look at. Do high fee advisors prevent more closures? Okay, this could be self-serving, right? I'm getting 2.5%. I don't want you to close because then I would end up not getting the 2.5%. So, but in that case, I'm actually helping you to stay invested. Okay, so if there's kind of some differentiation using this event, that would be nice. And on the flip side, do retail investors who invest on ETFs on their own, are they more likely to meddle? Are they more likely to try to time the market and lose even more than 2.5% when they are trying to do that? Okay, so some other benefits that I think I've already mentioned just now, that they could help, maybe tax preparation, compute capital gains. They help you to reduce some of the costs of investing in equities. Or else, another possibility is, if you invest on your own, maybe you still have to pay 2.5%. In that case, it's better to invest through an advisor. He may kick back, some of that fee to me, right? So maybe send me a hamper when I'm in a hospital or something like that. Right? Okay, so some other specific comments, if I have time, is regarding the methodology. So the cost of passive investing, I think the paper seems to assume that is 0. Probably the tracking error of any ETF or index fund is going to be like 10 to 50 basis points. So I think either they could use a passive benchmark as a factor, or at least tell us the expected average or typical expense ratio, typical tracking error of passive funds that mirror the advisor's portfolio. Okay, so and I wasn't quite sure what are the assets that these Canadian mutual funds invest in. Are these Canada-based stocks, or do they invest in US stocks? Because when you talk about farmer French factors, are these the Canadian equivalent of them? So it was not clear from the text. And so of course I use this instrument for my benefit, but so one of the questions I have about this instrument was, if it reduces the supply of financial advice, kind of the level of financial advice, but because the regulation requires now financial advisors to be under more scrutiny, maybe the remaining financial advice increased in quality. So it's not clear to me what's the net effect on some kind of quality adjusted advice. Okay, so basically that's all I have. And to conclude, we see that advisors don't help clients to reduce fees. Okay, but they help them to participate in risky assets. Okay, and we can think about some other benefits that they give to investors. Otherwise, why would they continue kind of paying 2.5% to these advisors? Okay, thank you.